led the rally this week, and for some that means value stocks are back. Others it might mean junk is getting scooped out. The Russell led the rally this week, and for some that means value stocks are back. Others it might mean junk is getting scooped out of the garbage can. Let's bring in Lee Munson joining us from Portfolio Wealth Advisors, President and CEO. Lee, how do we determine what is value, what is trash?
Well, first of all, there's a couple different type of value plays, right? There's value in sort of like the vernacular, banks, energy, industrials, utilities, things that we refer to value because all we really mean is something big, mature, pays a dividend. It's a slow grower in that classic way. Then you have actual value stocks that could be, one could make a case maybe a Google might be a value stock. If you look at something and take, Peter Lynch, who's one of my favorite mutual fund all-stars of all time, would say that if your growth rate is higher than what, say, your PE is, that's a good value. You take classic Warren Buffett matrix and look at that. Then you have the third value, which is just a value trap. That just means a stock that goes down and down and down and down and down. Kind of like General Motors at 3 times, earnings. What's happening at 3 times revenue, General Motors, is that people obviously think it's going to be bankrupt and not around in 10 years. So I think what's important when you're talking about value versus meme stocks, right? Value stocks versus, say, a GameStop that has negative CAGR growth, sequentially, lowering, like not a damn thing about it that is going up. I think you have to decide, am I talking about an individual stock that's trading cheaply versus what its growth rate is? Or am I just talking about value stocks, which are really defensive? They might be more cyclical stocks in these other areas. Going into next year, to answer your question, meme stocks are going up for one reason. The crap rises because there's a hope on Wall Street, a lot of hope, Oliver, that the Fed's going to cut so fast that all of a sudden these companies are going to go back to junk bond markets, go back to investors and say, give us money before we go bankrupt. And there's a lot of short covering in the last month where people who are short saying, if rates stay higher, these companies will literally run out of money.
Exactly. Won't they be able to get a further extension now? Is there a real possibility their life just got extended?
Well, I wouldn't count on it. I wouldn't make that trade. I mean, if you're trading meme stocks, you're just being a degenerate gambler, which there's nothing wrong with that as long as you know it. I would say that you really have to, there's 2 things you have to overcome. One is the Fed going to cut enough? And number 2, who's going to actually put money in now, knowing that they were so close to the edge? Versus a stock like, let's take a stock like Enphase. Okay. Solar company, they sell inverters, right? They're up like 20%, very much on this Fed pivot.
Totally.
They're a company that actually earns money. The PE is real high. It's not the greatest company on earth, but put it this way, it's jacked up on goofballs right now because there's a belief that the consumer who generally buys solar stuff using credit, they get a loan to buy it, that their volumes are going to go up. That's a great example of not really a meme stock, but what I would say is sort of a lower quality, a little bit of dodgy company, but it's a real company. They have real products. The valuation's just high, and they have problems with sales because rates are too high. So that's definitely something that I would be into on a rate cut. But that's not a value stock. Okay. Take a look at something in Magnificent 7.
So we're working our way up the quality spectrum in this basket, right? I like that because the bottom is the meme, the stuff that you mentioned, and then the next one is like, okay, low quality, but at least it's got something going for it. And now we're kind of at what, the higher quality?
Yeah, exactly. And remember that mid-grade, it's not that it's okay quality, but sales versus borrowing money, sales are dependent on lowering rates. I like that better than just your existence is based on
your own financing. Someone else's financing.
Exactly. Now you have a Google. They're not going bankrupt tomorrow. They don't need to borrow money. What's really going on with that is that you are looking at a PE around 20 going forward. You're looking at growth averaging next year very much above 20%, right? I'm not saying it's cheap, but great companies never get cheap. Now, if you go into this as a classic kind of Buffett mentality, you have to believe that for once in Google's life, they're going to execute properly on AI. Well, they may not. They're going to execute on their third-rate cloud strategy. Roll the dice, maybe. If you know more than me and you think they're going to do it, that would be kind of like a classic Peter Lynch or even a Warren Buffett value stock, even though it's in the Magnificent Seven, right? And so that's a completely different thing than just rates going down, stock goes up. But compare and contrast that. And I'm not saying you should go out and buy Google. For full disclosure, I own a little Google. I have some clients that own Google. Do I think they're going to execute? Well, I hope so.
Yeah.
But then you take a look at Procter & Gamble, McDonald's. Oh, those are value stocks, right? Well, Procter & Gamble, McDonald's, two very different companies, but they're big in the value screen.
Okay.
They have multiples over 20. They have growth rates that can't break above 7%. Now, is that really a value stock?
What puts them? Is it their dividend, their ratios, their payouts or something?
I'll tell you what the real thing is. When you sort out these value ETFs, what they're looking at, a lot of it has to do with price to book. So Procter & Gamble, McDonald's, they have, or utilities, they have these huge fixed costs. Think of them like big factories. They have stuff.
Yeah.
Whereas
yeah.
book, like there's not a lot of stuff there. Some of these big tech companies, now granted, Amazon's got a lot of stuff because they got a lot of service, but it's not the same thing. So that's why you get companies that we call value stocks. All that really means, it doesn't mean they're cheap. They can be, just like growth stocks can be cheap. It just means that they're slow growing. They generally pay a dividend, which is your clue they're slow growing, because if you're paying a dividend, you're telling shareholders, we can't utilize all of our profits.
Sure.
And you have a lot of companies like in energy where big fixed costs. So there's nothing wrong with having value ETFs. There's nothing wrong necessarily Procter & Gamble, McDonald's. I have a lot of value in my portfolio, but I also barbell that with a little of the S&P, a little of the NASDAQ too going into next year.
Okay.
Right? Because when I look at growth rates versus their current multiple, there's a lot of stuff in the Magnificent Seven, a lot of stuff in the
That's a really good
NASDAQ
point.
that actually has really good growth rates versus where it is. Now, be careful on stuff like NVIDIA, right? It's like at a 50 PE, maybe a little less. 300% growth rate. But next year, that's going to start slowing down. And, a couple guests ago, they were talking about what happens when they start cutting prices. So you have to remember that it's not just about this quarter. You got to look a year out. But again, separate out a value ETF, which is just big, slow moving companies that were great to own in 2022.
I love the price to book point on those companies, because that only really kicks in if the company's got to sell off assets, and okay, great, you're high up in the credit spectrum. I love the differences in the valuation analysis, Lee. Super helpful stuff, especially the price to growth too, and the tech companies that haven't gone extremely ballistic is still offering some of that. So I think it's really useful, especially when we're trying to figure out value from the trash. Good stuff. Thank you very much, Lee, for your time.
Thank you.
Lee Munson, Portfolio Wealth Advisors.